We had a fairly mixed market today. However, Google was pretty much flat. That was because the market was waiting for their earnings, which they have now just released after hours. Bear in mind, market right now is sitting in extreme greed, and whilst valuations are stretched, one of the few companies that actually look reasonably or in fact attractively valued is Google themselves. Now, they've released their earnings and they were in fact, before recording this episode, down around 2 to 3%. We've seen the market change. They're currently up. However, things do move very quickly. By the time you're watching this, they could be up a few percentage more, or they could be back into the red. Already, they're up 2%. Now, we're just going to cover what happened in the earnings, a quick valuation update, and factor in this company hasn't had the best year, up 5%. Year to date, they're now pretty much flat. And over the last 10 years, as we will come to show you, they have outperformed the S&P. They're also trading at the upper end of the 52-week range. They haven't got to their all-time highs yet, around $207. And not only do both Seeking Alpha and Wall Street give this a buy rating, very near the 4.5 to flip this into a strong buy. Now, getting straight to it, they did outperform analyst targets. Earnings per share, $2.31. Market was anticipating 2.2, so a nice 5% beat. And revenue, quite significant. We're talking nearly $3 billion higher, 96.4. Expectations just under $94 billion. And whilst a beat by 3% may not seem like a lot, we are talking about a very significant number. And then in terms of visualizing their performance, absolutely phenomenal. Revenue was up 14% year on year. Search advertising, which many analysts say is dying, that was up 12%, strong double digit. We love to see that. Does give investors confidence that for the time being, search is still here to stay and Google are in number one place. We have YouTube up 13%. This is now bringing in $10 billion worth of revenue every single quarter. And we want to highlight Google Cloud, absolutely phenomenal, up 32% year on year. Not only their fastest growing income stream, but also one of their most profitable. And we do get to see some efficiencies, gross profit up 1 percentage point, likewise their bottom line. So overall, from a quick glance, very strong, although we will get into some of the worries the market has started to factor in. But again, for those that like to see it on a numerical basis and from their report, we can see here not only very strong performances, but also other bets, which does include the likes of Waymo. That is up $365 million, same quarter last year, now sitting at $373. Perhaps investors wanted to see this a little bit higher, but at least this one moving in the right direction. More importantly, their search, which as we've highlighted before, makes up more than half of their top line. This quarter, $54 billion versus full revenue of $96, has been increasing and in fact double digit. We also get to see the ever sexy Google Cloud moving in the right direction on a compounded annual growth rate, 28% year on year. We just saw a phenomenal 32% increase into June 25. And in fact, if we go back to December 2019, we can see it is increasing 35% year on year. Not only that, whilst it did turn positive in March 2023 from an operating income basis, we can see it has only continued to climb higher and higher. Investors will love to see this. And if you want to see it in terms of the makeup split into the different income streams, we can see ad revenue up 11% over the last few years, cloud up 28.5%, subscriptions up 18%, just continuing to climb, continuing to move in the right direction. And if you want to go even further back just to see that consistency, well, very obvious to highlight, this company only continues to move in the right direction, and for the large part, each income stream, more often than not, is climbing double digit. We're talking every single quarter. Now, also important to understand why this company did drop as soon as their earnings were released, as we highlighted, down 2 to 3%, as this is something that investors will start to digest the information, consider this, and perhaps we will see this move into the red tomorrow once the market opens, or not. Definitely something worth understanding. But if we look at the capital expenditure just in 2024, it was sitting around 53 billion, with Sundar Pichai saying estimated 2025 to be around the mid-70 point. Well, we can see, in fact, it has increased in terms of against expectations. We're hearing around the mid-80s just in the first 2 quarters or first half of 2025. We're talking around 40 billion. That is nearly the full year of FY24. And in fact, first quarter expenditure was up 43%, Q2 up 70%. And that has also affected their free cash flow. Not a good sign. We can see it around 5.3 billion. Previous quarter sitting around 19 billion. But investors want to understand, are they going to be getting a return on all of this capital? Now, ultimately, for the large part, we can see Google do produce some very high numbers. Most recent year, 26%, trailing to a month, 25%. So if they do get to see that return on these very high capex figures, then ultimately it won't be an issue. But we can see this is what investors are really starting to scratch their head about. And we can see it confirmed here from CNBC. They're estimating around 85 billion. That is 10 billion higher than their projections. We're just talking about February, so not that long ago. However, important to understand the reason for this. And we can see this is due to strong and growing demand for their cloud products and services. So whilst on the face of it, increase to capex, not looking good, the reason actually makes sense, especially the growth we are in fact seeing on their cloud. I would say very strong report overall. Revenue, as we highlighted, a very nice beat. Same to go for EPS. YouTube advertising, remember with this company and some others, Wall Street do like to look at a few other headline points, and YouTube was a beat. We get cloud revenue, also something very important for Google to outperform. Otherwise, I do believe they would have been punished today. Traffic acquisition costs also looking good. In fact, revenue, as we highlighted, up 14% year on year. Market was only expecting 11%. That is a very impressive performance. And whilst we said capex is an issue, hopefully now the market is starting to digest this, and it does look like we will end the after hours green. Hopefully something we see into tomorrow, or in fact, as an investor, maybe you want the opposite. You want it to come down lower so you can add more. Remember, in terms of the valuation, forward P of 20, still below their 5-year average of 22. Solely based on this in isolation, we would say it's undervalued. And if we were to take a look at the blue tunnel, remember within the parameters here, it is the intrinsic price, fair value. It is just inside the bottom, so reasonable valuation / slight undervaluation. But over the last year, you would have had plenty of times to buy this in a severely undervalued level, notably around Liberation Day. But if we zoom out to the last 5 years, you can also see there was plenty of time, in fact, during this period where you could have bought this severely undervalued. As we say, more often than not, this is one company that continues to be both mispriced and unloved by the market. And then on the flip side, what was interesting to see, because Tesla also reported their earnings, whilst Google was down a few percentage points, we had Tesla up 1 or 2. Now we're starting to see Tesla drop slightly from the initial performance, and Google start to move from red to green. And why we say this is interesting, because whilst we had Google report some very strong performance, we saw the opposite from Tesla. Their revenue down double digit overall. We saw deficiencies to gross, operating and net profit. However, investors will have reasons for why they continue to pile into Tesla and why they continue to sell out of Google. The company is still projecting double-digit growth, both year-on-year is what we saw and expected into 2026, although we have to factor in over the last 5 years, this company was growing faster. Earnings per share again looking impressive, projected 14-15% over the next 3 to 5 years. Sector a lot lower at 11, and yes, we understand over the last 5 years, Google was growing both at a faster revenue rate and on the bottom line. And remember, not only is this company very profitable, A+ rating, but they have efficiencies. They're improving not just top line revenue, but also their margins. Gross profit around 59% on a trailing 12 month, above their 5-year of 56, above the sector of 53. Bottom line 31%, well above their 5-year of 25, above the sector massively. So very strong in terms of the profitability department, and they're generating a ton of cash, 133 billion from operations, well above their 5-year average at 93 billion and significantly higher than the sector in the millions. They do in the next 3 quarters expect 2 of them to be growth, 1 of them a drop, and now with the release of Q2 earnings, they've outperformed in the last 5 quarters. Very consistent company, 100% track record, and we note forward P expected based on next year's numbers to drop to 18.6. This is a company, however, that over the last year has still underperformed the S&P. In fact, when we incorporate the QQQ, they've also underperformed that. Google up 6%, S&P up 14%, QQQ up 18%. But this doesn't hold true when we zoom out to the last 5 years. Google up 153%, S&P up 97%, QQ up 124%. And they maintain that dominance and that outperformance over the last 10, although marginally against the QQQ. Google up 486, QQQ in fact 441, S&P lower at 200. Past performance, not an indicator of the future, but great to see Google over the last 10 years, even with the issues they've had, even with the unlovingness from the market, the fact that they've still continued to be mispriced, they've managed to chug along and in fact continue to outperform. Worth flagging though, whilst institutions hold 40% ownership, whilst they sold 52 billion, buying nearly twice as much at 95 billion, in the most recent quarter they did sell more than buys, 1.7 billion versus only 1.1 million of buying, and that is a fairly rare reversal of the trend because prior to that we can see a lot more buying than selling. Q1 fairly indifferent, you'd have to go to Q2 to again see a lot more selling than buying. Yes, more often than not we do notice, as we see on a trailing 12 month, institutions more bullish. They are net buyers in fact of the company, but perhaps something just to factor in the most recent quarter they were selling more than buying. We'll also let you know when we do get the release of the latest super investors portfolio, their buyers and sells in Q2, whether we see any movements in Google, so make sure you are subscribed, we will inform you. Now before we look at our valuation, just to let you know we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away. And you can also grab a copy of severely undervalued stocks for the month of July. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now our valuation gets to $200 derived from the DCF model, where in fact we have the free cash flow year on year, most recent increase 5%, average over the last 10 at 20%. Moving forwards, we've got 10%, although you will note a low, medium and high. Numbers, as always here, are subjective. You can grab a copy of this model by clicking on the pinned comment below, running your own numbers, whether it's for Google or any others. But based on 10% and the discount rate, we get the present value of future free cash flow and terminal price, add together with the cash, subtract total debt, get to equity value, divide by the shares outstanding, getting to $200, indicating 6% upside. Worth noting though, using a reverse DCF, right now baked into the price is 9.2% growth moving forwards. If you believe it should be higher, then in fact, company looks undervalued. If you believe it should be lower, then in fact that means you see this as overvalued. We'll also highlight for transparency, if you see this at 8%, then intrinsically 174, it means downside of 8%. If you see this higher, you're more optimistic at 12,229, indicating 21% upside. Now, as typical on the channel, we will take through the middle rate of 10%. We're not done there because we apply an MOS. 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in the episode today, well, in fact, it isn't a buy at that point. You'd have to wait for $180. Right now, it sits bang on 5%. Wall Street themselves also see this at $205 into the next year, upside of 8%. But give us your thoughts. Maybe you agree, maybe you disagree. On the back of these earnings, are you more cautious? Are you more optimistic? Do you see it effectively as a buy, hold, or avoid? If you want to see the different rates, at 10%, a buy at $180, at 20, $160, and at 25, $150. But as we said, right now, based on the growth rate of 10%, there's only 5% margin of safety. We'll also highlight, for those that are more optimistic, at 12%, the margin of safety levels. And at 10%, we can see a buy at 206. Naturally, the MOS will be larger. You're factoring higher growth. At 20%, not quite there yet, so somewhere between 15 to 20%. Overall, give us your thoughts on Google and their latest earnings. Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.